Welcome to everyone who's joined us for this webinar, where we'll be hearing firsthand what LPs want to hear from GPs in order to stand out in what we've all agreed is a highly competitive fundraising environment. I'll ask our panel to introduce themselves in just a moment. But first, I'd like to encourage everyone who's joined to put questions in the Q&A, and we'll do our best to get to them during the webinar. If we don't get to your question, we'll follow up with an email as appropriate. Okay, investors at the moment have multiple GPs vying for their attention. Their inboxes are noisy and their calendars are full. In a crowded fundraising market where there's roughly $1 supply for every $3 demand, easy fundraisers are now the exception, not the rule. And the bar is higher for proving that historically good returns are a predictor of future performance. While performance is objective and can be benchmarked against peers, we're hearing from investors that they want to clearly understand GPs' people, process, and philosophy from the outset. GPs need to work at building conviction in their investments by building trust with their investors, both during and between raises through transparent communications and frequent updates. The GPs who seem to be standing out during fundraising are the ones who listen, do their homework, and show that they understand an LP organization's priorities and mission. And what seems to be proving effective is a show-don't-tell approach, with data backed by qualitative reporting on both the successes of portfolio companies and also their headwinds and challenges. For example, one GP we spoke to recently recounted a strategy they employed during COVID, where they produced white papers on each of their portfolio companies that outlined the individual challenges the pandemic created and how each company was planning to tackle them. It was so well received by her investors, it's become a permanent part of her firm's communication strategy. As a GP, you need to excel at pitching your competitive edge alongside your track record. It's crucial to prove why your strategy will be successful not only in the current market, but also in future market conditions. The deciding factor for an investor could be whether you can convince them that your performance is down to skill and not just luck, especially in a down market. My name's Sar, and I lead marketing here at Pass-Through, and I'm joined today by my co-moderator, Marley, who's from our partner organisation, Altvia. She's their product marketing manager. And of course, our expert panellists who are going to give us insight into both sides of this LPGP story. Muriel Doherty, who is Director at 50 South Capital, and Erin Musgrave, who is VP of Investor Relations at Bow River Capital. Muriel, let's start with you. Can you please introduce yourself and give me a brief description of your role over at 50 South?
Yeah, hi. I'm Muriel Dowdy. I'm a director at 50 South Capital on the private equity team. 50 South is Northern Trust's alts platform. We invest for Northern Trust clients as well as outside clients in buyout, venture capital, growth equity, and hedge funds. At 50 South, as mentioned, I'm on the private equity team. So I am one of the 3 people that leads diligence on buyout funds and co-investments. I've been here for 3 years and am based in Chicago.
Great. And what's the first, this can be a very general answer because we're going to dig into it a little bit more later, but what is the very first thing you look for in a GP?
Yeah, I think in terms of like an outreach or initial email, it's really having a clear, concise idea or pitch as to what you do and why you're good at it. I think, again, the concisity thing seems to be a bit of a theme, and that I think providing extra detail is helpful, but within, with those first emails or first outreaches, just being very clear about what you actually do and why you're good at it.
Mm-hmm. Yeah, I'm sure. And Erin, I'd love you to do the same. Please introduce yourself and give us a brief description of your role over at Bow River.
Sure. Thank you for having me. I am a vice president on the investor relations team at Bow River Capital. We are based in Denver. Bow River is a diversified alternatives investment manager. We've got about $3.5 billion under management, and we have 5 different investment strategies across private equity, growth equity, real estate, and an evergreen strategy. And I've been in investor relations my entire career for 15 years now. Prior to this, I was at a Los Angeles-based firm, and I've been at Bow River for 5 years. And so our role here on the investor relations team is to work with our existing investor base and also constantly looking for new investors as well.
Great. And I'm sure over that, this is a whole different webinar topic, but I'm sure over that 15 years, your role has changed dramatically as far as
Yes,
scope and strategy.
very much so. Yeah. And the private markets landscape has changed a lot too. I think it will play a lot into this conversation, but it's, from my perspective, become a lot more competitive. There's been a lot more managers entering the space, even in just the last 5 years. And so it changes really how you have to operate and how you can get through to people.
Yeah, I'm sure. So with that in mind, and without obviously sharing any proprietary information, what do you think has been your most effective pitch to an investor?
Yeah, I think for me, when I can go into a pitch and feel confident that our strategy is differentiated and that I can clearly articulate what we do and why it might be better or different than what somebody else is doing, that's when I have the most success. When I personally don't feel confident that in the strategy or why I think we're better, that's when I struggle. So for me, it's the confidence and it's knowing that we have something different than what other people are doing.
Yeah. So leaning into those differentiators.
For sure. Thank you, Erin and Muriel, also for joining this webinar in the intro, SAR. But Muriel, like SAR mentioned earlier, your inbox is extremely noisy. A lot of fund managers are trying to, vie for your attention with requests for our meetings to, pitch their thesis. So you said that, GPs that reach out to you that are clear and concise definitely get your attention. But let's double click into that. So kind of what makes the GP stand out, like after being clear and concise, like how are they, getting that meeting with you?
Yeah, definitely. I'd say, to your point, we get a lot of cold emails and it's often hard to, one, figure out how they found us, but two, differentiate between different managers.
Right.
And so I'd say one, it's helpful if, we get a sense of like where they found us. Maybe it's a referral from another GP, maybe it's a placement agent,
Sure.
maybe it's just off of Prequin or something, but like, it's not just a total cold outreach.
Right.
And then secondly, in the initial email, maybe a sentence or two about like what differentiates you, what makes you good at what, your specific strategy. I'd say one pager attached is often quite helpful because otherwise it's just a paragraph of text without a lot of
For sure.
context. But and then I think lastly, I think I personally appreciate when people follow up if I don't respond. Sometimes stuff just gets buried. So 2 to 3 emails if like you're interested and I'm not responding is maybe I'll respond in the second or third time because I'm just busy. But beyond that, it's just frankly a little annoying. So I'd say like persistence is definitely good and appreciated, but there's a point where it's probably not a great use of the manager's time to continue to reach out 6 times if we haven't responded.
For sure. Yeah, that makes total sense. The balance of persistence and annoyance, you have to always manage that. But yeah, I'd love to turn that question right back to you, Erin. What's a strategy or tactic, that you found most effective when you are trying to get in the door with an LP, leading with that first communication, when you're, trying to gain a new prospect LP, prospective LP?
That's super helpful to hear, Muriel, because I always wonder like what's too much, what's not enough. Like if they're not responding after the first time, does that mean they're not interested? So it's good to hear from your perspective. I have a little bit of an old school approach. I try to do very little cold outreach. I think all of us are just getting so many robotic, cold outreach emails that have no connection. No, it's just like you can tell that it's written by a bot or
Right.
somebody that has no idea what's going on.
Mm-hmm.
And so if I do cold outreach, I always try to do 2 things, which is find a common connection point. So like one that I can think of recently that was successful for me was I had reached out to a prospective LP in the town where I went to school. And so I just said, hey, I'm a graduate of this college. And instantly that's like, okay,
Yep.
I'll at least open it perhaps. And then I usually spend a significant amount of time like researching on the website. It's helpful for me to know if they're a good prospect. But if I see something that catches my eye, I will drop that directly into the email and say, like, per your website, it looks like you're assisting your clients with finding outside managers or whatever it is. It was that in that case.
Right.
Just showing that if you're going to take the time to respond, I should take the time to put something into the email. So,
Yeah, absolutely.
in that case, he kind of responded, like, I get a lot of cold outreach and I got to give you a compliment. Like, you took the time and did that. So, just that from a cold outreach perspective. And then kind of once you can get your foot in the door, my approach is listen more than you talk. And I think a lot of GPs don't take that approach. But I just like to hear, ask questions, make it more conversational and less of a pitch.
Yeah, totally. Something that I recently saw, sorry, Sar.
No, go ahead.
Work well, just to Muriel's point as well, of like balancing, this is the 5th email that you've sent, is just, hey, if this doesn't pique your interest, just let me know and I'm gone, and that's definitely something or a tactic that I've seen work well, of just managing expectations and say, hey, totally understand if this isn't the right time.
Managing expectations and respecting people's
yeah, for sure.
Well, that's a nice segue into my next question. So you've got your first meeting booked. What's next? What makes a GP stand out to you, Muriel? Like, is it a particular proof point? Is it the way they present? What is the first thing that makes them stick out to you?
Yeah, so typically in an intro meeting, we'll either schedule 30 minutes or an hour, depending on, how busy we are. But we like to get through background in team, strategy, track record, and then maybe a case study or two if we have time. We're fairly indifferent as to whether people go through a deck or, sort of do it on the fly. But I think that the key differentiator is, at the end of the call, do we understand what the strategy is and why you have, some sort of advantage in that space? I can't tell you how many intro calls I do that after an hour, I still have no idea like what the fund is investing in or doing. So I think it's the ability to really be sort of like nimble in your pitch and tailor it to the time that you have with the LP, but also B, specific questions they have. If like, again, using the deck isn't something that like they're super into.
So being able to read the room basically, and adapt. And this is a sort of very piece of string question, but in your point of view, what should that conversational balance be? Should you be doing all the talking? Should they be doing the majority of the talking?
Yeah, usually I think I personally like when at the beginning of the call, GPs will often say, we have a deck, we're happy to go through the deck, or we can just answer your questions on the fly. I usually just say, like, go through the deck and we can ask questions along the way. But I think asking goes far, and it shows that you are considering, you want to know what's important to the LP. I have had calls where I've sort of been like stopped I've asked a question midway through and I've been stopped and been told, basically don't interrupt
that later.
Yeah. Or don't interrupt me.
Yeah.
So but like, otherwise it's sort of just like making sure that you at least ask if there's anything specific that the LP wants to cover at the beginning of the call.
And flipping that back to you, Erin, you've booked the first meeting. How do you approach it? How do you lean into the things that you think make your organization stand out?
Yeah, I think I agree with a lot of what Muriel said, and I think she brought up an interesting point, which is sometimes as a manager, you know your strategy inside and out, and you know what you're doing really well, but to be able to articulate that, not in a dumbed down way, but just in a more clear, concise, like, simpler to understand. Because if you get too into the weeds, I think on the first call, yes, you know what you're doing, but you're trying to make sure that the person on the other side of the call really understands and grasps like what you're doing. So I think that's a really good point. And just you have to kind of step out of, okay, you know this in and out, but make sure that the other person just at least gets the high level stuff. I mean, I think, performance at this point is table stakes. I see there being a little bit of a trend towards managers who are more specialized rather than generalists. And so being able to articulate again your differentiation, I think for us is really helpful.
So specialized in what sense? In sector and strategy?
Like if you're doing, like, for instance, if you have a buyout fund, you're not looking at every buyout, deal. You have a size range. Maybe it's a geographic focus. Maybe it's a sector focus, a single sector focus. Like it's becoming more, it seems to me like becoming more, the market is just trending more towards specialists.
Oh, interesting. And I just wanted to go back to one of the points that you raised. Just completely gone out of my head now. So we'll move on. I'll come back to it.
Sounds good.
Yeah. So Sar and I actually attended the Women's Private Equity Summit in Phoenix a couple of weeks ago. At this point, maybe it's a month ago at this point. I don't know. Time's going by so fast.
Yeah.
But yeah, a very popular topic at that conference was co-investments. And so I'm curious, Muriel, like, what are your thoughts on GPs offering co-investment rights to LPs? Is this seen as like a competitive edge? Are you seeing this kind of like be more popular? I'm curious your thoughts.
Yeah. So we have we raise our own funds. We have fund of funds vehicles. One of those vehicles is a co-investment vehicle. So that is something that we will do. I think obviously LPs like them because often it allows them to blend down their fees.
Right.
I'd say not always, but it's pretty standard today to have at least semi-fee-free co-investments. So I think like LPs like it again because you can blend down your fees. I know some LPs have a requirement where they have to have one-to-one co-investment with their fund commitment. That's not something we do. But I think like for us, when we see that other people have first rights, it's not something we love. I think it's a good way to bridge to your next fund size. So if if you're raising a $250 million fund and your next fund is a $500 million fund, and you can say we invested $400 million, including co-invest, it's just a little bit easier of a story. But on the flip side, it is, money you could be taking fees on. So I'd say it's something we definitely like and other LPs like, but often you will not be taking fees on that additional co-invest money. I mean, it's a nice carrot, I think I would say.
For sure. Yeah. What about you, Erin? Is this something that like you're leading with in conversations with LPs, like offering right off the bat, or is it more in like the negotiation area?
For us, we have pretty much stuck to, we only offer co-invest for fund investors, and we don't promise a lot, partly because of the size of the market, lower middle market that we're operating in, and just smaller deals in general. But so for us, it's interesting for me to hear Muriel's point of view, because I'm finding that a lot more LPs are looking for co-invest, and they're often looking for just co-invest, or 2/3 of what they're doing is co-invest and 1/3 of what they're doing is fund commitment. So for us, that makes it more challenging, because if we require a fund investment and then we'll offer co-invest, it just seems the market is trending a little bit more towards co-invest heavy. And so, thinking about how that plays out for us, and
Sure.
But it's not something we lead with, but it is definitely something that's more of a conversation today, I think, than 10 years ago.
And what do you think is driving that trend? And this is a question for the both of you. What do you think is behind that trend? Is this a way for LPs to kind of diversify their fund manager base or their strategies? Where do you think that's coming from?
I'm happy to go first. I think there's sort of like two buckets. There's the sort of, I guess, bucket of LPs that more or less require co-invest alongside their fund commitment. I think that is an effort to get lower fees without getting lower fees.
Right.
You know, like some managers will offer co-investment with 90% of their fund investments, and that's really just like you're getting fee-free deal flow. That's, you know, not that specific scenario is not super typical, but I'd say like that's probably what those LPs are going for. For us, if we have the opportunity to like size up with a manager we really like in one of their, you know, strongest partners in a really great deal, that's definitely something that that we like to do. And so like on our side of the LP spectrum, it's more increasing our exposure to, you know, some of the best deals if we can.
Yeah, sure. And what's your take on it, Erin?
I think some of it is to Muriel's point where you've already underwritten the manager. And so if you can, you know, like 50% or whatever percent you assign to the work is done in terms of you're comfortable with the manager. And so it's just getting comfortable with the deal. And I think some of it too is just having more control over what goes into your investment portfolio. With a blind pool fund, it's, you know, maybe it's that you don't like every deal, or I don't know if that's the best way to say it, but just having more control over where you're really picking your spots, I think is a big contributing factor. And then obviously fees.
Sure. Yeah. Yep. Let's pivot a little bit and talk about timelines. So, as we've all acknowledged and we're all aware of, it's a really tough fundraising environment. A lot of fund managers are extending timelines for various reasons. Muriel, what's your kind of if a fund manager comes to you and the timeline, they've changed their timeline and maybe they've done it once or twice or three times, what's your kind of perception of that? How do you want to see that presented, and what does that immediately make you think?
Yeah. I'd say transparency is always great to have. Like we're going to figure out if you've been in market for 3 years. So it's just easier if you know, tell us and explain why. I think during COVID, like a lot of funds that started raising at the beginning of 2020 were in market for longer than they may have been historically, and that's totally fine. And the story makes sense. But, you know, when we find out 6 months in that they've been raising for 2 years, and it's sort of like, it's just like, it's better to just, you know, be upfront about it. I'd say, you know, a year and a half is pretty typical. 2 years is like getting a little long, but still explainable. Over 3 years is just sort of getting there. There's a question as to like why either the fund target was too high, the expectations were too high, or just not good at marketing yourselves or whatnot. But it's taking away time from doing deals. So that's sort of like also why it's a bit of a concern. But I think like, again, over the 2-year mark, people start asking questions. And often firms will hire a placement agent, which, you know, they're not free, but like if you can get the fundraise done with a placement agent in 2 years, like might be worth, again, the fee. And you can't be a year and 3/4 in and say, we're having trouble now, we're going to hire a placement agent.
Right.
So just like kind of, you know, having a good understanding of where you might get earlier on, either, you know, talking with LPs, current LPs, when you're not fundraising, to get an idea of what their capacity is like. But also when you start fundraising, like where you're going to get and where you need to make up room in terms of the target.
Sure. So like you said, transparency is key. Sorry if I'm having a couple of connectivity issues. My laptop just told me my connection's unstable, so apologize if I'm cutting out. But transparency is key, and
there
being
she goes.
you just missed me apologizing for my internet being unstable. So there's proof there.
No worries.
So just to recap, Muriel, transparency is key, and being proactive about this planning rather than reactive kind of gives you peace of mind. Is that a good
Exactly.
Yeah. Erin, what's your take on that? I know you guys have relatively short timelines for fundraising.
Yeah, have had kind of shorter than a year fundraise timelines for all of our funds to date, but also it was a different fundraising market. It's kind of turned in the last year-ish, I would say. And so, going forward, who knows? I think those are really good points. For us, it's the reason why we try to make them so short and we before we're in market is that we feel it's very distracting for our investment team to have to be on the road and fundraising and doing this whole other job on top of their normal day jobs, and which is already a lot, as we know. So just to try to make it as quick as you can has kind of been our approach. But again, the fundraising market is a lot different today than it has been, so easier said than done.
Totally. Yeah, that actually is a nice segue into the next question of obviously fundraising, it's such a relationship oriented exercise, and but given the state of the current fundraising market, offering transparency, having existing relationships, they really are table stakes, especially with all of the competitive, it's just so competitive as well with other strong fund managers. So what's your take, Erin, on finding successful tactics or approaches to ensuring LP re-ups when you are fundraising? Are you cultivating those existing relationships or putting more emphasis on finding new investors? What's your approach there?
Yeah, I think it's both of those.
Yeah.
The key for us is forming a real relationship, not just when you're fundraising, not just when you need something, but in those, we have longer fundraising periods of time in between the fundraisers as well. So it could be 3 or 4 years. And so for us, it's what can we be doing in that time frame to really make sure that the relationship will be as sticky as I can. Obviously, stuff happens, but I think it's really off-putting if you don't hear from a manager for 4 years, okay, you did this fund and then you don't hear from us for 4 years, except for our normal form of communication, partner letters, these kinds of things, annual AGMs. And then when they're back in market, they need something. And so you hear from them again. We don't like that approach. And so we go out of our way to build the relationship in the interim. I think the other key thing from my perspective is just being really honest about when things aren't going right and getting ahead of it. Hey, we're having trouble with this deal. These are the reasons why. This is what we're doing. Instead of them finding out after the fact and oh, it would have been nice to know, why didn't they call or give us a heads up, or especially, if it's good to communicate the good, but I think it's almost more important to communicate the bad, to just show that you're on top of it, you care about the relationship, and that you're doing the best you can to make things right.
Absolutely. Yeah. Again, just highlighting that the importance of transparency. Muriel, do you agree with that, of the partnership approach to the relationship making with GPLP relationships is key for a long-standing partnership?
Yeah, definitely. I mean, things happen, but obviously, and people's budgets change. But I think when you're fundraising and somebody re-ups or doesn't re-up, it shouldn't be a huge surprise in most cases. So you want to have sort of an ongoing dialogue, like Erin said, and a relatively open, I think, relationship helps.
Totally.
I heard it framed in a really interesting way recently where I can't remember who said this. I wish I could, but They said we used to treat investors like mushrooms. You know, we'd bring them out, would ask for something, and then we'd put them back in the dark for a few years. You just can't do that anymore.
No.
But that was a nice visual.
There's too much competition now. I mean, if
Yeah.
you're not investing in that relationship, someone else is, and they're gonna take your, they're gonna take over. So
Yeah.
100%.
Changing demographics simply come with different expectations as well. So it's the fund manager who can adapt to those who will be the winner.
Also, sorry, we do have a couple of questions in the Q&A that we can look at, but I'm curious, Aaron, while we're looking through those, obviously, with proving a successful track record, that's so important in getting investments, right? But how do you prove to an LP that it's not just luck, like it's your past success isn't just luck, that you are, successful for these key reasons? How do you approach that?
yeah, it's challenging. I think some of it is just comes with time and having done deals and more importantly, having exited or realized deals. I keep hearing, I don't know if it's just me, but I keep hearing all over the place, DPI is the new IRR. And so, there's got to be a reason for that.
Sure.
But so that helps, but that's, if you don't have that, it's obviously out of your control. So, being able to convey why your process is repeatable in a very clear way, I think is probably helpful.
Yeah.
And being able to articulate it and having a, actual process in place.
Totally. We actually talked about this a couple of days ago, but Muriel, you made a great point. I think you were saying like the ability to also articulate lessons learned and how you speak about past mistakes, of kind of how you take a investment strategy moving forward is also key in those kind of conversations with GPs. And I think that was a super great point. Cool. And then Muriel, when you're speaking with GPs, how are you kind of evaluating that they're going to be committed to portfolio companies' success? What are kind of key indicators there?
Yeah, I think like not surprisingly, size of the team. If you have 3 people and you have 30 portcos, that probably doesn't work.
Yeah.
So like, is the team right sized, or at least are the resources, be a better way of putting it, right sized? I think like we will do, several multiple calls with portco CEOs before we invest, and those are important. Again, like not infrequently, the portco CEOs like don't have great things to say about, the time and attention of the manager. So, it'll come across there. But also again, at least if it's a fund 2 or beyond, we'll have references with other LPs as well. So there's multiple data points, I guess, for us to sort of like check if the manager is doing what they say they're doing and not just, letting something ride after the first year.
Totally. Yeah, execution is key.
We had a couple of great questions from the audience, and I'm going to put this one out to whoever wants to answer it. But how does the lack of distributions in the market change the transparency around value creation with portcos? It's a really interesting question.
Say it again, sir.
How does the lack of distributions in the market change? Oh, it's just gone. Sorry. How does the lack of distributions in the market change transparency around value creation with portcos?
Yeah, I think the question is it obvious if people are just distributing or selling and or doing div recaps just to get DPI. I think that's what the question is sort of getting at. I mean, like DPI is important because unrealized is like exactly that. You can mark things at whatever you want as long as your auditors say that it's reasonable. So like, DPI is just like a real proof point that the strategy has worked. But like people are, I don't know, we notice if like all of a sudden we know you're going to fundraise in 2 quarters and you're just selling stuff. Like LPs can see if it's you're selling to sell, or if you're doing a div recap just to get some points on the table. Like we don't love that, but like again, we care, I'd say, equally about IRR and TVPI. So if it sort of gets some IRR points, that's nice. But again, I think like people can sort of like pattern match, and it's pretty obvious if you're just trying to return some capital just to say you've returned some capital. So and if all your prior companies have been exited, this is obviously fake example, but at a 3x, and suddenly you're selling something in year 4 at a 1.5, like they're probably going to ask questions. So people can, I'd say, figure it out. But at the same time, if we haven't gotten any distributions back from any of our managers, we can't commit to any new managers in theory. So I think distributions at least gives people some money, some new money to commit. But again, like people can figure it out. I don't know if maybe Aaron, you have different thoughts on that.
I think I would agree. I'd agree with what you're saying. I hadn't thought about it from, your perspective. I just have like the manager perspective. And so for us, it's like, we've just been told constantly over the last 2 years that, we're not getting any distributions. And so from our perspective, it's important to us for the companies that are ready, not like pushing stuff out early or anything like that, but for the businesses or the real estate properties that are ready, make best effort to get those out into the market. So I see where you're coming from too, though.
And there's another great question, which is sort of related to this. How much do you factor cycles and vintage years into performance? Like how heavily do you weight those?
We consider, and I think most LPs consider at least, Cambridge or something else against the manager's performance. So if the fund is a 1.5 and that's top decile for that vintage, like that's a great fund. So I think it's like, again, it's most LPs look at performance on a relative basis, either against Cambridge or, PME or some other benchmark.
And is that how you would approach it in a general sense, Aaron?
Yeah, I think so. I think we're always looking at relative performance, but also our targets are always kind of, for our lower middle market PE buyout fund, we're always kind of targeting the same return no matter the vintage. But then when you're looking at it, on a backwards looking basis, yeah, relative is, I mean, you have to, you kind of have to look at it from a relative basis.
Sure. We're getting some great questions in from attendees. This is an interesting one. So speaking of transparency, LPs and their representatives in general show very little transparency into their process and timeframe. What are some best practices where GPs are demonstrating transparency? Whoever wants to pick that up.
I'd be curious to hear what you like, Aaron, on your side, and then I'm happy to answer.
Yeah. I mean, I think for me on a first call, having an understanding of what the actual investment process is on the LP side is helpful. And I always try to ask that question because it varies so much. Like your big institutional investors, sometimes they only go to IC once a quarter and the decision-making process is really slow. So like, just having, it's nice when the LPs even will offer it up. Okay, so as next steps, this is, we're going to take this fund. We meet IC weekly. We have a general discussion, and then we'll let you know next week if we want to move forward and have further discussions. Like having a clear understanding of what your timeline is helpful, because you have to remember too that we don't want to be bothering you, but we also know that you're really busy and have a lot of other managers that you're talking to and other things you're working on.
Right.
And so just to kind of manage those expectations of, I'll follow up with you next week if you tell me that's when your IC's meeting, or I'll follow up with you in 2 weeks, and then I can kind of better, we can better align our communication cadence that way, I think. Most LPs, I think, if you ask, will tell you, and they usually have, some process in place. But it's interesting, I think, if you don't ask and you leave the call and you don't know, and then that's the worst position to be in, because then it's like, all right, what do I do from here? And you don't know.
What are your expectations? Yeah.
Mm-hmm.
What's your take on that, Muriel?
Not too much to add. I'd say if you don't ask, then we're probably not going to tell you, just because it's taking time away from questions we want to ask. So it doesn't really hurt to ask. Like, I think people may be concerned it comes off as presumptuous.
Yes.
But like, I don't think, like, if somebody liked or didn't like something, that wouldn't really move the needle at all. Asking and they can say, like, it's different depending, they don't have to answer.
Right.
So I don't think it really hurts to ask at all. But, well, like, I'd say we get asked maybe 10% of the time about our timeline and what we like and, et cetera. But yeah, 100%. Like, I don't think it hurts to ask.
That's a really interesting stat, that you only get asked, 1 in every 10 calls, because I think there's a way you can ask it too that's not like, I get it coming from the GP side. It sometimes can feel presumptuous, but you can ask it in a way of, if we were to move forward in this process, like what would that look like, just so that we can have the same expectations, or we can be on the same page. There's a way to ask it that's not like, okay, what are the next steps? Where that feels to me pretty presumptuous. But I think that's very interesting that most people just don't ask, and then you're kind of just in the dark of, all right, well, we'll wait to hear from you, maybe. I don't know.
No one likes waiting.
No.
Okay, we've got 2 minutes left, so we'll do a quick fire. Let's start with you, Muriel. Give me your top 2 or 3 do's and don'ts for GPs.
I'd say top 2 do's, just be flexible in how you pitch, given sort of, LP expectations. Also, again, be concise. Make sure that you're really communicating why you're good at what you're doing. Maybe don'ts are, don't be rude. If somebody, if an LP stops you in a call to ask a question, like, just, it's fine to say, we'll get to that in a few slides, but I hate to say that. It seems like it should be pretty obvious, but just sort of be polite. And also, again, like, if you've emailed someone 5 times and they're not responding, they're probably either not interested or they're busy and get back to you. So limit the number of times that you send the same email.
Yeah, great advice. And Erin, what are your top
I'll
2?
I'll do don'ts and do's together. So my don't would be, don't just contact LPs when you're fundraising, and do build that relationship in the interim. I think that's key. Being a do would be honest in your communication, like we were talking about earlier. Talk about the bad and not just the good. I think that it builds so much trust when you can just be upfront and say, this is what's gone wrong and these are the lessons we've learned. And so building that, trusting relationship is such a big part of it. So those would be my two big things.
Great.
Amazing.
All right. Well, let's wrap it up here. This has been super interesting, super insightful. There are a bunch of questions that are still coming in, which we'll try and follow up on email. But I would like to thank everybody who attended. I hope this was useful and insightful, and please feel free to email me or Marley if you have any other questions. And particularly like to thank Erin and Muriel for their time and their insight and their wisdom. Much appreciated. And I'm sure I can speak for everyone who is on the call to say that they appreciate it too. Thank you
Thanks so
all.
much, Erin.
And
thanks so much, Muriel.
Sorry.
Oh, sorry. I was just saying thank you as well to them.
4 years on Zoom and we're still messing it up. No, but a big thank you to you all. Appreciate your time and appreciate your insight. And we will see you on the next webinar.
Thank you.
Thanks so much.